Hey there, everyone. Welcome into the Investing in Real Estate show. I'm Clayton Morris. So glad to have you here. We're going to be joining our audience here in just a few moments. So, kind of get started here, a little pre-show. We're going to talk about what the 1% rule is for real estate investing today, and when to use it, when not to use it, what it actually means. So, that's what we're going to be talking about. So, we got the chat overlay here today. Let me see. How does that look? Let me see if you guys... Just let me know if you guys can see me okay here in the chat. Just say hello, everybody. Let me know where you guys are joining us from. Got a bunch of people here joining us, which is great. Great to see everybody. Over on Facebook, good to see you. Over on YouTube and also on Twitter today. Lindsay H is here. Good to see you. Grover is here. See y'all. Watching lumber prices today. Actually, crazy lumber prices hitting a new record high today. Crazy. It's been off the charts with these record high lumber prices, and I don't know when it stops. To be honest with you, it's these numbers are just continuing to climb. So we'll start here just in a few minutes. Nathaniel Gilchrist, good to see you. Hey there, Shay, good to see you. Yeah, look at these lumber prices. Breaking all-time highs. Sawmill owners are going to have big profits. Good news is, like on our team, I'm super excited about this, is that we've already locked in our lumber prices for the foreseeable future. So that's what it pays to buy in bulk. Look at these prices, though. Almost $1,600 for 1,000 board feet of lumber right now. Crazy town. That is crazy town. So today we're going to be talking about the 1% rule. Good morning, Joseph Samilio. Am I saying that right, Joseph? Yeah, let me know where you're joining us from here in the chat. Mike, yeah, those lumber prices are crazy. I saw a meme the other day. Someone sent out an Instagram post that showed, someone said, "Hey, I just passed a billionaire on the highway." And it was a photo of a guy pulling a flatbed truck full of 2x4s. Hey, is it Sunil? Am I saying that right? Cole over on Facebook says, I like the new chat feature. Riverside, California. Good to see you. Nikovox. And so, again, if you're just joining us, we're seeing Janet Yellen speaking today to reporters. Talking about, she's, of course, the Treasury Secretary, and here she is saying that interest rates may need to rise modestly because we are about to see runaway inflation. Not runaway, but we are going to see some pretty significant inflation. So where do you want your money right now? Do you want it in the U.S. dollar? Let me know in the chat, where do you think the best place to put your money is right now? Teresa Dulia says, I moved some of my 401k into my brokerage account. Now what? How much did you move in there, Teresa? That's right. Mr. Tax Sale says real estate, $28K. Well, I'd say, you could work with us. Our minimum down payment on one of our rental properties is going to be in the $40,000, $45,000 range. So, but do you have other accounts that you can couple that with? You could also borrow from your 401k as a vehicle for real estate. But right now, I mean, when I'm seeing these inflation numbers right now and concerns from the Fed, when Warren Buffett says they have very substantial inflation is on the way, and he sees Berkshire Hathaway, that their internal analysis sees this inflation coming, That's trouble. Trouble in Toontown. That's all they would let you move out of there, Teresa. What about borrowing from? Did you borrow from it, or you actually removed it? Yeah, I mean, if you have any, and I would say look at what you've got available, and you could book a call with our team at Morris Invest. If you've got other ways, we've got financing built in on our properties. Think about how you can position that. I mean, as a store of value right now. To me, a store of value for real estate investing is the best. Yeah. Still infidelity. Yeah, just book a call with us. But Janet Yellen just saying moments ago, and look, the market is selling off right now. The stock market is selling off because of concerns right now over interest rates. Interest rates going to go up, Yellen says, but they're not yet. So my point would be to take advantage of these incredibly low interest rates right now, get into rental investing while you're seeing this hyperinflation that's about to come. So just get ready for that. Okay, we're going to start in a moment. I just wanted to make sure all these alerts went out. Great. Okay. Bring this up here, and then we'll open it up for some Q&A here in a minute. So welcome in, everyone, to the Real Estate Investing Show. I'm Clayton Morris, longtime real estate investor. The whole purpose of this channel is to make you a more intelligent real estate investor. I believe the number one store of value right now in the world is real estate investing. Owning rental real estate in this crazy volatile world. We already have, look, we have lumber prices skyrocketing right now. We've got Warren Buffett worried about rising inflation, saying that Berkshire Hathaway sees very substantial inflation rising. And so that's why they're being very cautious right now at Berkshire Hathaway. We see Janet Yellen just moments ago, right here live, just speaking to reporters, saying that interest rates will need to rise modestly. What does that mean? And notice it's a market sell-off. The Dow plunging. NASDAQ is down 367 points on that news. Do you want your money in that right now? No, you don't. You want your money in a tried and true asset that's a performing asset like real estate, or stores of value like gold and silver. Long-term stores of value, which are a hedge against inflation right now. So today on the show, I wanted to talk about understanding what the 1% rule is. You hear this being thrown around a lot by people. Just, buy a rental property and make sure it hits the 1% rule. So I want to tell you why you not necessarily can trust that number and what to really look out for. What does that mean when you're investing in real estate? So let's actually just start with the definition of the 1% rule. What is the 1% rule? Well, it's just a quick calculation. A little quick back of the napkin calculation. In fact, my father-in-law uses this calculation. When he asked me, he said, Clayton, the types of properties you build over at Morris Invest, tell me the numbers. And he's just doing a quick calculation in his head of 1%. He's like, that's like a 2%. He's like, that's even higher than that. That's not, he goes, I usually go with 1%. He's in California, so he's used to getting low returns. It's just a back of the napkin calculation that investors can use very quickly to determine if their investment will be profitable. Meaning, ideally, you'd want your monthly cash flow from a property to equal 1% of the purchase price. Okay, ideally. This is a little handy rule of thumb for just quickly evaluating an investment opportunity. Let me give you an example. So to use round numbers, let's say you purchased a real estate investment for $100,000. Well, following the 1% rule, can anyone ask? Let me know in the chat right now. Let me know in the chat right now what you think that would be. Do you think that would be, like, just give me, I would love to know what you guys think. Drop me a chat and let me know. Like $100,000 following the 1% rule, that property would need to produce what? $1,000 in rental income every month. It's a simple tactic used to ensure that your expenses will be covered. That's it. So when you should use the 1% rule, this is a good question. Again, this is just a quick rule of thumb. You should just be using it to quickly evaluate a property. Is it even worth diving more deeply into it? Is it worth your time? It should not be, and I've done other videos on the 1% rule, it should not be the be-all, end-all of running around and running the math on a rental property. It's a starting point, and you should use it as such. The 1% rule allows you to quickly determine the baseline cash flow and decide if moving forward with the purchase is a good move. And then you can get into the taxes. We can start to understand more about this property, and it allows us a base model. If it doesn't meet the 1% rule, I'm walking away. Like if it doesn't even touch the 1%, then this is not something you even want to think about investing in my opinion. So when should you not use the 1% rule? Well, generally speaking, if you're using financing, then the 1% rule is not going to apply to you. And folks, when we see what's happening right now, we see again, I'm looking live here right now at Janet Yellen saying that interest rates will need to rise modestly in order to cover what we're seeing here on this inflation index, what we're seeing on inflation. You want to make sure that you're locking in these amazing interest rates right now. And so if we are going to increase our overall interest rates to kind of ease this crazy inflation, which we're about to have 2-3% inflation over the next few months, into later this year, you're going to see higher interest rates. And so if you're using financing on a property, the 1% rule is not going to apply to you. A financed purchase of rental real estate is much different than buying with outright cash, which is where you would run that 1% rule. So if I've said it once, I've said it 1,000 times. You should not have to use your own money to build wealth. Now, don't get me wrong. Like you do need some money. In fact, earlier in the chat, we were talking with someone who's saying, you got to put some money down for a down payment, right? Like on our properties, they're between $40,000, $45,000, $50,000 down payment. That gets you into the property. But then financing, we work with over 60 different lenders on the back end. So you have to have some skin in the game, right? But I'll ask you this, what other asset can you buy where you only have to put 20% down and a bank is going to fund the rest of it? Can you name it? I can't. So let's say I wanted to buy gold. Let's say I want to buy $100,000 worth of gold. How much do you think it will cost me to buy $100,000 worth of gold? It'll cost me $100,000. Now, I want to buy $100,000 of real estate. How much will it cost me up front? Guess what? I can put 20% down and have a bank cover the rest of it. And now I'm increasing my overall internal rate of return because a bank is giving me the money at virtually zero interest rates. Even with these interest rates going up, they're still at historically incredibly low numbers. I mean, think about the early 1980s. The early 1980s when we had 1982, when interest rates were 18%. So even getting something that's, you're getting an internal rate of return of 15, 16, 17, 18% internal rate of return, and your interest rate is 3, 4, 5, even in that range, you're still crushing it. So of course, you're going to have down payments. But when you can use leverage to build your wealth, you absolutely should. So the 1% rule really only makes sense when you're looking at maybe a one-time all-in cash deal. That's really the only time you should be looking at a 1%. But like we at Morris Invest and Sedera Wealth do not follow the one-time all-in cash deal model at all. We're about building wealth and financial intelligence. So how can you turn that $100,000 cash into 3 properties instead of 1? The other day on my other live show, I was talking to somebody who said, I don't understand. The person said, I want to buy a house that I live in. And they said, I have $100,000 as a down payment and I want to buy a house to live in. And I said, what if instead you took that large $100,000 down payment and you actually use that to buy 3 rental properties? Now you're cash flowing, $4,000, $5,000, $6,000 a month. Cash flow. Now you could use that cash flow to fund an apartment you want to live in on the beach in Malibu. Think differently about how this stuff works. But if you could take that down payment amount, instead of buying all cash in a property, buy 3 instead of 1. Well, you should check out our alternative calculation. We have a whole video on internal rate of return. I want you to check out that video. We'll link it up right here. So you can watch that internal rate of return video. And I want you to smash that like button and subscribe to the channel if you're not already a subscriber. All right, I want to open it up for some Q&A on this question on the internal rate of return and the 1% rule. If anybody has some good questions about that. Let's see here. XRP Bush says, shout out to you, Clayton. Been watching you since the very first joined, when I joined the Big News Network. Fun digs with your house. Very cool. Thank you so much in Venice Island. Appreciate that. And so here is how we have the link right up here on the screen. Oh, sorry. Yeah, that's the internal rate of return video, but you can go check that out. Let's see. Burgundy Rich says you also get all the appreciation on the property, even though your down payment was only 20%. Exactly. So the reason internal rate of return is a better metric than ROI is because, yes, you're getting that additional benefit of appreciation against inflation. So again, when we're talking about this, when we're talking about, this very high and substantial inflation coming, as Warren Buffett sees it. I mean, this is why you want to be in real estate. We are seeing very substantial inflation coming, and we're already seeing it. We are raising prices at Berkshire Hathaway. People are raising prices to us, and it's being accepted. Get ready to see the price of things is going up. Inflation has begun already, so the price of things is going up. I mean, look no further than lumber. Gas. Are you guys paying more for stuff already? Are you guys paying more already? Someone says let's see who says it. Minesh over on Twitter says in California 1% is hard to achieve. Exactly. So I would never invest in California. Like where we build our properties in West Texas, we get an internal rate of return very high. So again, using financing, crush that 1% rule. Do you build, Joseph Maroon, what do you mean do you build in opportunities? Could you let me know what you mean by that? Mike says, yes, everything is going up. Mike, am I saying that? Camacion? Oh, do we invest in opportunity zones? Do we build and invest in opportunity zones? I'll have to check with the team on that. We've been analyzing some different zones that are potentials. There's a lot of trickiness with that. A lot of times the opportunity zones are in established areas already. So it's hard to come by the land to do that, unfortunately. And when you do that, then yes, you're getting fantastic tax benefits and all sorts of things. But we're not able to go in and build like 30 homes in this area because most of the time the opportunity zones that we're looking at are in established city areas. So there's not a lot of land for us to build. Thank you for that. In Midland, Texas, vacancy has only hit 1.5 months for me. Yeah, again, Texas is very good. Oh, I see what you're saying, to avoid capital gains tax. Yeah, but when you own rental properties, you're holding on to these properties for years. You're not, and then, unless Joe Biden gets rid of the 1031 exchange program, that's possible. So look at this, folks. Look at the stock market. The worst since March today. Look at that. Yeah. The worst since March. So big market sell-off right now because of what Janet Yellen just announced, which is that we're going to have to increase interest rates modestly. So get ready for that. In South Jersey, Vincent Jess is getting about 1% to 1.5% in South Jersey. Not bad. But, Jersey is a very difficult state. It's not a very landlord-friendly state. I just sold 10 properties in New Jersey, and I am not I'm not going back in there for investing. I'll tell you that. Because it's just not landlord friendly. It's just not landlord friendly. To get an eviction, you have to get a lawyer involved. It takes a very long time. We had a tenant in one property that knew what she was doing. She had no intention of ever paying. She moved in and immediately, like the whole house was renovated, brand new. We just finished it. She moves in and trashes it, and she was just a tenant from hell. But you might have that from time to time, but that was a huge mistake on our part, and never again. So, and it took like a year to finally get her out of there. What does that interest rate mean for the housing market? Good question, Julian. Well, it means, let's just look at history. When in 2019, the fall of 2019, was it 2000? No, it was the fall of 2018. When interest rates went up like 1.5 points, they went up from like 3 and something up to like almost 4.5, almost 5. It screeched to a halt. People it was also the holidays. So this happened right around like November-ish of 2018. Interest rates went up about 1.5 points, and people just stopped buying houses. I mean, it wasn't a huge, but I mean, yes, like people just stopped. Like the mortgage applications just kind of dropped down. Now, for me as an investor, it's a different animal. It's a different world. I don't really care what the broader retail market is doing. To me, there's always like a tale of two markets. There's what investors are buying, which, as Warren Buffett has said, if he could buy up every single family house in America, he would. And so he's got billions of dollars in real estate. And so as a store of value, so it's two different things, right? You've got investors over here buying rental properties for a cash flow, and then you have a retail homeowner who wants to move into a house. What you have right now, of course, is millennials who are buying homes for the first time, who are renting. So what they're doing is they're not trading the house they owned for another house. They're basically jumping into the market from a rental from an apartment, and there's just not enough homes. So I think what will happen from a retail perspective is that some of that supply and demand will finally get caught up. Some of those home builders will get caught up. Maybe some of those millennials will step back and say, maybe we'll wait till these interest rates drop a little bit, another point. So I think you could actually have some balance. It may actually help the retail home market actually keep these prices from going out of control, and actually help some first-time home buyers get into the market, I guess, and maybe alleviate some of the supply and demand problem. Yeah, Vincent Jess says about New Jersey. Yeah, not very friendly. Not very friendly. Lucky to have great tenants, though. Yeah, exactly. So if you've got great tenants and you're in good neighborhoods, then, that's what it... let's see. So today, XRP Bush says, can you comment on forbearance, please? Florida housing market insane. Prices rocketing. Multi-bid above asking. Will it end with forbearance? Thanks, Clayton. Thanks, Rob. Well, it's going to be interesting to see how much longer President Biden pushes this forbearance program, so people can say, hey, I can't pay my mortgage right now. I'm out of work. And they get caught up. But I think there's a lot of a lot of analysts who think that we are heading for a retail. Again, I want to classify these two areas here, like a retail housing crisis. Like it really won't affect me as an investor because I own the properties and I'm renting out to tenants. Now, the retail side, if there's someone who owns a house on the retail, they live in the house and they can't pay their mortgage over the past few months because of COVID, and now they've gotten a forbearance deferment from their bank, and they still haven't gotten a job and they're not going to be able to pay it back. Remember, you're going to have to pay that back at some point. The forbearance just means, hey, we're giving you a pause for now. I think we could see a huge foreclosure problem for a lot of these home buyers that are out of work or that cannot get caught up. There were over 3 million people, might have been higher, all behind on their mortgages through the forbearance program just about a month ago. So we could see, again, it won't affect me as a rental investor like it should. I don't see how that carries over really, because I'm not renting to home buyers. I'm renting to renters. So if a home buyer can't afford their mortgage because of a forbearance problem, then that house is going to go back to the bank unless the federal government steps in and stops it, which is probably going to happen. Democrats right now are spend happy. I can't imagine that on the president's watch, they're going to let all of these foreclosures happen because the banks are going to be knocking on the president's door. These big banks, Bank of America, Wells Fargo, they're going to be saying, Treasury Department, you got to do something. You got to step in here and extend this forbearance program or get some sort of a government subsidy program that can help people get caught up. That's, I don't know how you don't. You wouldn't go into another foreclosure crisis in the United States? We know how that went last time. Let's see. Sandra Ewing. Yeah, just saying that. I think there's no way. I think it'd be different. Honestly, I will say this. I think it would be different if it was on, if Republicans were running the show. I think Mitch McConnell is a heartless punk. And I think unless the banks came to him and said, hey, we're about to have all these defaults on mortgages and we're about to take a bath. But the thing is with the Fed would step in and take care of these big banks like they did before, while the little guy gets screwed. So I think under a Democratic presidency, I just the way that they're trying to secure, and I think, Senate, you have Elizabeth Warren, you have Bernie Sanders, the head of the Senate Finance Committee now. I think, it's the labor. I think you're going to actually see protections there. I would absolutely think that that's the case. Let's see, questions here. And inspiration in the night. I think see Nicole answering some of your questions here. So she's great at being able to answer some of those financing questions. Vidal Stewart. I saw one of your previous videos talking about a loan against my 401k. Looked into it, and it's an option for me. Going your route of buying approximately $40,000 properties in the Midwest. I live in Arizona, but I'm from Illinois. But what I would do, Vidal, is I would book a call with us. I'm not in the Midwest so much anymore, like where we are building our properties right now. And when you buy those lower cost properties, I just want you to be careful. That's where you can have issues, in my opinion. So with $40,000, $45,000 as a down payment, like you could work with us and get a brand new construction property at Morris Invest and have a team that's going to take care of everything with our Sedera Wealth customer service. You're going to be taken care of. And it'll cash flow from day one, and it's brand new construction with financing built in. So you're not using all of your own money. So again, here's our website. Let me just show you, like what we do is you just schedule a consultation, just go over and book a free call on our website. It's morrisinvest.com, and schedule a consultation, get your property match, and then our team does the rest. See, like these are one of our new constructions, like before and after duplex, single family, before, after, rented. So, these are some of the homes that you would get, and they're like, they're in the best school districts in Texas where the tenants stay for a long time. It's the most landlord-friendly state in the country. And the landlord protections are second to none in Texas. So I would caution you about just randomly throwing $40,000 at a random property that you have no team associated with. So just be careful with that, okay? But our team can handle it all for you. So if you want to book a call with us, we'll help you with that, Vidal. Let's see what other questions we have here. Thank you for that great question. Any other 1% style questions? Sandra wants, because you're saying you want to buy a house. Yeah, I mean, everything is just so overpriced. I mean, on the retail side, like our houses are still staying the same price, so we can get that internal rate of return. But like on a retail play, things are just exploding. So, and then this is where people get into trouble. They think, you really only want to spend like 25% of your take-home pay on a mortgage payment, right, or rent. So what people do is like, everyone's running and buying properties and going crazy, on the retail side. And you end up now you're like 50% of your take-home pay is going to a mortgage because you over leverage yourself. That's where you run into a lot of trouble, So I'd be careful about that. Let's see questions here. Yeah, but I would encourage you all, check out the other videos here on the channel. We do these live streams every Tuesday at noon Eastern time to help you, any real estate related questions. How many new people do we have watching? If you're new here, just drop it in the chat. Say, I'm new. Let me know you're new and tell me where you're from. And then click on the subscribe button. If you're watching us on YouTube, you can do that. If you're on Facebook, go ahead and follow us there as well. Good morning, Juan says, sorry, I missed this one here. Juan, good morning, Clayton. If you had the option, which would you start with first? Conventional loan or non-recourse loan? Assume good credit, and why? Well, Juan, that's a good question for our team. Like if you wanted to book a call with our team, we can talk with you about it because everyone is different. So you've got good credit, great. And conventional loans right now, the interest rates are so stinking low. You might think that's a great option. I would think that conventional is probably going to be the way to go. But there are some other considerations on the non-recourse side. For instance, maybe you already own 10 properties conventionally, and then there's a cap from the federal government. So, okay, how do I buy them beyond that cap? Well, that's where non-recourse comes into. Or maybe you're international, you live internationally. Or yes, maybe you do have some credit issue or, something like that. So non-recourse depends on who your certain situation, and we can massage that a little bit. So we don't really, that's the thing, Joseph, we don't really do cash on cash return on our properties. We do, you can pay cash, but we always encourage our investors to use the bank's money. Like, why would you want to use all of your own money? Like, as Robert Kiyosaki always talks about, like you build wealth through debt, other people's debt, right? So we use an internal rate of return, and Nicole, our range on like internal rate of return numbers, can you throw it up here in the chat? What are the new batch of properties that are being wrapped up and finished soon, like the new construction? I hate to throw out specifics. It's like somewhere in we always have like a range depending on it, because we've got like some of our houses in the $120,000 range all the way up to, in the $400,000 range. So it depends on the property and the size, either it's single family or duplex. Thank you, Carol. So anywhere from, on a cash on cash return, I will say, Joseph, let me just go back to your question here. On a cash on cash return, somewhere in the 8, I think is like on like on the conservative side, 8% net cash on cash. And then, but if you're using an internal rate of return, sky's the limit then. Marcy Young says, grateful for the information. Well, welcome. Did you subscribe to the channel, Marcy? Good to see you. Let's see. Judy, Mrs. Wonder Mama. Aren't all mamas Wonder Mama? And happy almost Mother's Day, by the way. Nicole says, yeah, roughly on average. So from our internal rate of return is going to be between like 17 and 21% IRR. Internal rate of return. So hope that answers it for you. It's so small on my screen. Is it Bilal? Are you guys developing properties in Illinois or Michigan where the inventory is very old and scarce? We are not right now. We actually spent, interestingly, about a year analyzing some Michigan markets. Our field team is fantastic. And so we won't even start building in an area until all of the numbers hit certain things with us. Low crime, population growth, school districts, property management availability, all of these things. Fortune 500 companies moving to an area, property taxes, all of these pieces, recession proof. And then and only then are we going to start acquiring land and start building. That's what our field team does. And so we analyzed Michigan for about a year, and there was a few things that were just sticking out to us that we just didn't like, and we couldn't reconcile it. And so then we did not end up going in there. So no, our main market right now, and we're constantly analyzing markets, but is in West Texas. That's our primary. And other areas, in Tennessee as well, but West Texas is a lot of our focus. But you can't beat it. You just can't beat it. Yeah. So Nicole brings up a good point. She said, our average internal rate of return is about a 17 to 21% internal rate of return. But then she also points out that that's not even including the tax savings. So that's just the numbers on the purchase and cash flow and appreciation. So that's not even including the tax savings that you get. Good point on that. We analyze a lot of different markets. We did a few years ago some things in Ohio, but we're not in Ohio right now. Sandra says, Clayton, I'm very green to owning rental property. Is it a bigger problem to owning in another state than the state I live in? I feel like that's a headache. No, it's not. Look, I own properties all over the country. I never see them. And I have a team that handles the property management. And every month I get rent. And if, so all the properties are, that we're doing right now are new construction. So this is an example of one of our duplexes in Texas. Like there is no maintenance that you're going to have to worry about for a while. It's a new construction. So if a tenant moves out after 3 years, then you might have some paint to deal with. And that's what the property management team would help you with. It'll handle everything. So, I own properties in Texas. I don't ever see them. And I go in my online portal once a month when we're reconciling our books on our rent every month from our properties. And the rent is there, deposited. And come tax time, we pay our taxes. Anytime you want to talk with your property management team, you can. They'll talk with you regularly about, they'll say, hey, Sandra, we think that now is a time after this tenant had moved out, time to raise the rents in this neighborhood. The school district is the best school district, so there's a lot of demand. But there is no better store of value than real estate. Nothing. Not even gold. Not even silver. Real estate as a store of value. Because with gold, you really don't get that hedge against inflation like you get with, it always kind of runs there, but you don't get the hedge against inflation like you get with real estate. and you don't get the cash flow, the monthly cash flow, and you don't get the tax benefits of owning and depreciating real estate. And you can buy it with other people's money. There's nothing that comes close. No one will ever win an argument with me about it, and they can't. I've gotten into arguments with one guy who, he says, what about raw land opposed to owning actual physical structures? And I win that argument because as a raw land owner, you still don't get the tax benefits that I get. So even that's about as close as you can get, owning raw land to owning actual real estate. But even still, I kick his butt. So I hope that answers it, Sandra. You don't have to worry about it at all. Like, I feel like if you're an investor in the stock market, Sandra, are you an investor in the stock market? I think you said you were, right? No, we're not in the Pittsburgh area. We mostly focused in Lubbock, and we're looking at other areas right now that I can't announce yet, but we're constantly analyzing. But Sandra, let me ask: do you have money in the stock market? See if it pops up here. Because what I always say is, so many people are worried about, well, okay, yeah, should I not invest? Like, if I'm going to buy a rental property, then it needs to be in my backyard. But guess what? Most of the time, you do not live in the best rental market in the country. So you can't think that way. Unless you happen to live in West Texas, like right near where we're building, like in the best rental markets in the country, near Texas Tech and all of these new universities and hospital systems and healthcare and Fortune 500 companies, unless you happen to actually live there, but chances are you don't. And therefore, like Robert Kiyosaki owns properties all over the country, Oh, Sandra says, no, I don't have anything in the stock market. I have some cash and wanted to know what to do. Oh, gotcha. Okay. So I was going to say, I forgot who earlier mentioned they had just taken some money out of the stock market, out of their 401k. But my point is that when people invest in the stock market, right, they invest in Coca-Cola and Ford and General Motors and GE, and then they're worried about owning properties in their backyard because they want to see them. And I asked them the question, like, well, do you ever go to Coca-Cola's headquarters? Do you go to Ford's headquarters and knock on the door? Like, hey, I just want to see how my investment is doing here. Can I come in? So most of the time, like if you're investing in the stock market, you're never gonna be in that situation. Sorry, phone call here. Forgot to put that on silent. So my point is that when you have a great team, and you can travel to West Texas anytime. You can come meet the team, walk, check out the property, meet the property management team anytime you want. See the neighborhoods, see the restaurants. Any other questions here? Oh, Billy or Bilal, let me see this. For someone who is looking to buy a house and also become an investor, what do you suggest? Keep waiting to buy a primary residence first and then invest? This is where I'm at. Well, if you've watched my channel for any length of time, you know my position on buying a house that you live in. So let's say you're thinking about buying a $300,000 home to live in. You're going to have to put down 20, 25%. And you're going to live in that house. And now what? You just spent a huge chunk of change on a down payment in a property that is not performing for you. You're living there, you're paying the property taxes, you're having to go to Home Depot to fix things up. Not to mention the fact that you just blew your whole cash on a down payment on a property that's not performing, that you live inside of. Imagine, though, instead, if you just rented where you wanted to rent, best neighborhood, best school district, etc., dream home, whatever, and you're paying $2,000, $1,500 a month or whatever it is in rent, but you took that down payment and you bought 2 or 3 rental properties that are now producing $3,000, $4,000, $5,000, $6,000 a month in cash flow. You're getting the tax benefits and you're getting the cash flow. Now you can use that $5,000, $6,000, $7,000 in cash flow every month to pay for wherever you want to live. And yes, eventually, if you want to use that $5,000, $6,000, $7,000 a month in cash flow to put towards like a down payment and then buy a house. So the old adage, of course, is what Robert Kiyosaki always taught is, yes, you can buy a house to live in as long as your performing assets are paying you to live in that house, right? Then you're not trading time for money at a day job. You want your performing assets to pay for your lifestyle. So in that situation, Bilal, I would think, if you could rent or be in a situation where you can rent in an area where you like to live, use that down payment money to actually create wealth for yourself, building net worth while these interest rates are so stinking low. You just saw Janet Yellen just now. I don't know if you tuned in a little bit late, just announcing that they're going to have to increase interest rates modestly. She said, modestly. We don't even know what that means. But they're going to have to do something because we're about to see runaway inflation. And how do you combat inflation? Have a hedge against inflation with something that outperforms. Real estate historically appreciating 4%, 5%, 6% conservatively. Inflation 2% going to 3%. You need something that's above that. Guess where the US dollar is? And then look at the stock market sell-off. The biggest sell-off today, down 165 points today. NASDAQ down 400 points. Where do you want to put your money? Sandra, yeah, book a call with us. We'll take care of you. It's very simple to do on our website. Just go over to Morris Invest. We have a link right here in the chat, but just click on the book a call button and a little thing will pop up for you to pick a 30-minute calendar time. Sorry, I'm not showing you this. I'm sorry. Plus, we've got a ton of great resources here, but just click on the book a call button here. And you can see, come on over here. You can see all the, tons of testimonials. You can read reviews about our team. You can see all funding options, other things right here. See what our clients say about us and watch all these videos of all these people that bought properties this year from us and see all of it. It's been amazing to see, these are all people, a lot of these people bought properties in 2020 and early part of 2021. See some faces that have already closed this year on properties with us. A lot of new faces on here too. So yeah, you don't have to do it alone. We can help you with that. That's what we do. And then there's no ongoing fee. You own the house. Our fee is just baked into the fact that we build 30 houses at one time. So we're able to provide a great internal rate of return. You own the house 100%. You own the deed. Plus you have a tenant in the property cash flowing, and it's all handled by our customer service team. So our property management team is making sure that everything is running smoothly. And plus our team checks in on you monthly, making sure everything's going great with your property. And then we help people. So we have so many repeat clients because they're adding properties year after year after year and building that towards that freedom number. So I hope that helps. Let's see, what's this question? Julian, how much is okay per single family after all expenses and property management fees, etc.? $200? You mean in cash flow? Look, if you read Gary Keller's great book, The Millionaire Real Estate Investor, one of the things he talks about is as long as your property is cash flowing at least, after all of your expenses, everything, taken into account, fixing things up, you've taken out 40% for rehab, repairs, taxes, etc., and you're paying your mortgage and all that. If you're cash flowing at least $100, he actually says, I think in the book, $1. I like to say 200. If you're cash flowing at least 200 above all of your expenses, gravy. And you're building your net worth. You're lowering your tax basis. You've got a tax shelter. So all of these things are powerful. So that's kind of the rule of thumb. Average number of duplex bedrooms. Nicole, do you want to answer that? I believe the average I think mostly we focus on, I think we mostly focus on the 3-bedroom, 2-bath on our duplexes. the average number of bedrooms in the duplexes, and they're big. So the beauty of our duplexes is the reason I only do single families and duplexes mostly is because I want people to stay a long time as a tenant, and people tend to stay longer when the space is bigger and they're in the best school districts. So you have in these duplexes vaulted ceilings and stainless steel appliances and granite countertops. And we have a whole bunch of videos right here on our channel that you can watch of our walkthrough of our new construction. So, yeah. Fam Jackson, is it a requirement to use your management and customer service team after closing? No. But I don't know why you wouldn't. We have the best in the business. So you'd literally be taking from the best customer service team in the business and doing whatever you want with it. But you could, it's totally up to you. You could buy that. I don't know why, I really don't know why you would, but there's no contract or anything, except with the property management team. I believe you're in a property management team contract. Like any property management team, you sign a lease agreement with them for probably 1 year or whatever it is. Yeah, Nicole says 2 to 3 bedrooms typically. But that's the beauty of this kind of investing. I mean, you own the property, fam. So, fam Jackson, you could do whatever you want with it, My advice would be if I, like what I do is just hold it for the rest of my life as a store of value. But you can do whatever you want with it, But I guess I would ask you the question, fam, why would you want to work with a full service team if you didn't want to work with a full service team? You know what I mean? If that's a thing that you're thinking about, then maybe you should just do it yourself, find a realtor, try to hire contractors, buy raw land, pay this much for lumber, lock in these lumber prices yourself, build it yourself, find tenants yourself. I guess I'm saying I just don't quite understand the question, but maybe you're just saying, hey, am I locked in? Do I have to? No, you can do whatever you want, but I'm just saying, oh, you are your own management team. I see what you're saying. Well, then great things to ask, right? Then I think that would be, I think that would be a great thing. Then great questions to ask. You'll find as a property manager yourself, if you work with our team, you'll be able to talk to our property management teams that we work with, and you'll be able to ask them the tough questions. And we do not work with property management teams unless they've spent years in business. They have great software, great customer service, great screening processes, criminal background checks, all of the stuff. So that's what I would recommend. That gives you a leg up, but to ask great questions of the property management team. Fam, I would just say, I know that you are you are a property manager, but are you a property manager in the areas where we're managing, where we're building our properties? I wouldn't want you to make a mistake and you live in Arizona trying to manage a property in Texas. That's not, you need to be right there. You need to be boots on the ground right there, in my opinion. That's my opinion. I've seen some of these fly-by-night, not you, I'm just saying some of these big national property management companies, and I've seen nothing but headaches when they try to remotely manage a property. We only work with property managers who are right there. So fam, I would just say, hey, take that off your plate. Continue to manage the properties that you do for your business. And if you want to work with us, we'll provide you a great headache-free experience. In fact, it's funny you bring that up because we actually we have a lot of investors who have been they flipped houses for years. They've managed properties for years where they live. And they're like, you know what? I am so burnt out on doing this myself. I just want a full hands-off, great property. And we have a lot of people like that. Nicole, I bet you could even name some people right here in the chat. Some investors who work with us who spent years kind of doing what FAM has done, in other markets, and they're just like, you know what? I want to finally have an investment that I don't have to think about, that I can just do myself. So let's see here. Vidal says, I'm relatively new to your channel, absolutely new to rental investment. Is $40,000 the minimum amount of cash I would need on hand to work with you and your team? I can set up a call as well. Yeah, Nicole, I think that's right. It's right around there. 40, 45 is like the minimum, right? For one of our properties on the low end. I think that's like the lowest, right? So yeah, I think that fits. Yeah, Nicole says we have many of those investors who did it themselves for years and were just sick and tired of doing it themselves. But yeah, that should be, Vidal, I would just set up a call with us, because $5,000 is something that, even if that's off by a little bit, go ahead and set up a call, and they're going to walk you through that process. I mean, $5,000, even if you're off by a few, like, we can get you into the system and start like walking you through our process and get you set up. Well, thank you, everyone. I'm kind of losing my breath. I'm kind of losing my voice today. I think maybe it's allergies. I don't know. I did our other live show for 2 hours today on broad-based investing news, and then today on real estate. So I am losing my voice right now. Bill Purdue. Let me see what Bill says here. Good afternoon, Clayton. Hope all is well. I've had my second month of cash flow with your company, and it's amazing so far. I've had some early maintenance issues, but the team is working on it. Thanks for all the great advice. Thank you, Bill. See, there you go. Thank you, Bill, for saying so. And hopefully our team is taking care of it, the maintenance team and the customer service team. And sometimes with new construction, I mean, like, we moved into a new construction house in New Jersey, and it was big. And, it's new construction. You move in. Sometimes there's like a cap that's missing. That's what that rattling is all about, and so the team takes care of it. So hopefully it's not a nuisance for you. Thank you, Bill, for saying such nice things. Well, thank you, everyone. It's been great having you here today. I appreciate all of your feedback here on the show. I hope you like the new chat features here. We're trying to just making sure that it's flowing nicely for you. And yeah, looks great. I think this looks great. See how that looks when I pop that up there. Thank you. Renee says, you need to give that voice a rest. Give Grover a pat for me. And please tell Natalie, wish her a happy Mother's Day as well. Thank you so much. Yes, happy Mother's Day to all the mothers. So I probably won't see you because Mother's Day is this weekend. So see you next Tuesday if you join us here live on our live show every Tuesday at noon Eastern time, where we talk real estate, watching the markets, watching what's crazy happening with interest rates and inflation coming hot and heavy on this inflation front. So lock it in with real estate. Protect yourselves. Much love to all of you. We will see you back here again next week, everybody. Peace out.